As helpless retail traders whose net worth is held hostage by the health of a handful of oligopolies in publicly traded markets, we've all got one burning question on our minds. When is the big one coming? Here's the answer. I don't know. Okay, thanks for watching. I'll see you in the next one. Seriously though, I don't know the answer. But fortunately for us, there are a bunch of influencers on YouTube who do know the answer, so maybe let's check in with one of them. Anyway, I don't know when the big one is coming, and probably neither do they. So the next best thing I can do is just talk about what I might do to hedge against a potential market slowdown and or potential collapse. So first things first, if the market does collapse and unemployment were to rise, you need to do your very best to stay employed and keep those Wendy's paychecks coming in. That way you can be one of the people who were smart enough to buy the market on its way down the last time there was a crash. I'm serious, now is not the time to join a pyramid scheme or start dropshipping. Keep your day job, if you can. Run far away from any finfluencer who tells you that the 9-to-5 grind is for suckers, because they're usually trying to sell you a course about how you can become a multimillionaire by the end of the week by dropshipping novelty dog turds. Or in a more self-aware turn, selling courses about how to sell courses about dropshipping novelty dog turds. The name of the game in an economic downturn is survival. You need to stay in the game long enough so that you don't have to liquidate your stonks to pay for rent. So that's number one. So right now, the only substantial positions I have in my trading portfolio as of December 22nd, 2024 are two long positions in Google and Uber. The rest are smaller option plays and just hedging things that are overall pretty inconsequential. Basically a few spreads I'm down on but too stubborn to close out. What I'm trying to do is whittle that 50% deployment down to about 30% by the end of December in anticipation of the tax harvesting dip. The short call I have against my 100 Google shares should take care of that by December 27th at expiration. Unfortunately for me, I could premium via covered calls, and my most recent short call basically cannibalized a ton of the capital appreciation I might have gotten from just sitting on the shares. Fuck! As you can see, I sometimes find it hard to take my own advice about not getting in your own way during a bull market. But in my defense, I wasn't expecting Google to shoot up to $190 as quickly as it did, especially before year end, and since we've still got some unknowns around their federal antitrust cases. I made a video about Google's antitrust woes earlier this year, so you can watch it if you want, but to give you the TLDR, my thesis is that I'm not too worried about Google because I'm broadly bullish on oligarchy. Anyway, this video will probably be released after New Year's, so we'll see how my approach to year end plays out. Honestly, there's a good chance that some of you will be laughing at me for not being bullish enough. And just to add insult to injury, just watch as the market gods turn Cathie Wood's Tesla stock prediction into a reality. I don't even know what to say anymore. I know I said you should run with the bulls, but this shit is getting ridiculous. But if I start taking short positions against the market now, and on the off chance there is a slowdown, I'm going to look really smart. I call it the Dent Kiyosaki approach to predicting market crashes. Basically, if you predict a market crash every day from now until the sun explodes, you will eventually be correct, and eventually taken seriously by the financial media. You can then accumulate a cult following of doomers and permabears who you shill commemorative silver coins to, and down the road you can probably pull off a few crypto shitcoin rug pulls. But in the new year, depending on how much caffeine-induced euphoria I'm feeling, I might pump my stock holdings back up to 50%. That 50% number seems to be my center of gravity, so there's a good likelihood that's how much of my free cash will be in stonks, when and if the big one hits. I've said this before, you generally can't afford to miss out on the gains made in bull markets. So being fretful and sitting on the sidelines maybe isn't the best option. I'll be damned if I let the greater fool theory slow me down in my accumulation of overpriced financial assets, because as a retail trader with a negative net worth, I know for a fact that Jay Powell's got my back and the government has my best interests at heart. But just in case that's not true, I'd like to try to hold on to some cash if possible. If you're feeling a bit nervous, you might open up a small short position against the market using SPY puts, or perhaps even go long on a VIX security in anticipation of things getting a little nutty. All easier said than done, of course, but everyone needs a hobby. So, moment of truth. Am I nervous about a potential market downswing? Sure, I think lots of people are. We all make passing jokes that stocks only go up while wondering how sustainable the current trajectory really is. My own desire to reduce my stock holdings to 30% of my overall portfolio stems from a general wariness of the largely uninterrupted upward momentum we've seen. When contrasted with several quarters of mediocre personal income and savings levels among consumers, it feels like the ground floor of our economy might be a little bit shaky. As a YouTuber who occasionally pretends to be an economist, something don't feel right. I know institutional investors own the vast majority of equities, but we still need to reckon with the fact that if people are using apps to borrow $200 from their next paychecks to avoid overdraft fees because they've only got $12 in their bank accounts, that just feels like the sort of thing that might make it harder for companies to continue on their undeniably noble quest of growing earnings to infinity. I think we sometimes forget that stocks are shares of real companies that have real customers and economic headwinds, rather than just ticker symbols whose sole purpose is to serve as gambling vehicles for degenerates on Wall Street bets. After all, many publicly traded companies have retail customers at the end of the day. And even those companies who exist largely in the B2B space provide goods and services to other companies who ultimately serve the largest body of consumers. People whose entire net worth is either tied up in a rickety house with a roof that hasn't been repaired in 45 years, or their rusted mom van whose check engine light is on more often than it's not. If the above described person can't afford to pay their internet bill anymore, Google and Meta can't continue to print money by feeding them targeted ads for Spanx and hair loss supplements. And at that point, well, it's just Jover, isn't it? You can't squeeze blood from a stone, ladies and gentlemen. Now that I've conjured up some depressing imagery into your mind, I will say that my general outlook on stocks remains fairly bullish, with some broader headwinds attributable to me having some doomer tendencies, as you can no doubt tell from my previous comments. I'm not a negative or overly cynical edgelord, but you have to be living in a truly blissful state to not see that everything is kind of on fire. Like, more so than usual. But we're not here to dwell on that. We're here to talk about cash money and how to make it make more of itself. We've all seen how susceptible market prices can be to Jerome Powell accidentally saying the wrong thing to a reporter because he's in a rush to use the bathroom or whatever. Doomer or not, I'm still a greedy profit maxer, and I know myself well enough to know that I'll inevitably start reflexively going long on stocks anytime I see a company I like dip like 0.5% or start trading below its 52-week lows. But rather than short individual stocks or the market as a whole, I might consider taking a more aggressive position by going long on volatility. Of course, this comes at a cost, because whether you buy shares of a volatility security like UVXY or calls on that security, these are financial derivatives that mostly decline in value, until of course there's a sudden spike in volatility. So given my desire to hedge against a potential downswing, I'm about to suggest something fairly radical, which is to, gasp, use options the way they were intended, as a volatility hedge, as opposed to an undefined risk gambling operation where I lose 4 times my portfolio value over the course of an afternoon. If I let my intrusive thoughts take over, I might decide to go long volatility by purchasing a leveraged VIX futures ETF product like UVXY. But those are trading at about $22 a share right now, so I could get even nuttier with it and buy calls against this security instead. UVXY calls are scratch-off tickets that pay out in the event of a sudden volatility spike. As you can see, there are a handful of situations where this might have been profitable in the past, but mostly, leveraged products like UVXY are highly speculative instruments which should only be used if you really know what you're doing. Or if you're bored and need something to post about on Wall Street bets after you lose a bunch of money within a few days. Keep in mind that if you do this, you have to do it with the understanding that you're most likely going to be throwing your money into a fire pit. And by most likely, I mean that's exactly what you're going to be doing. There are lots of ways to effectively short the market, and while betting on higher volatility isn't technically the same thing, a sudden market dip is probably going to be the most significant catalyst for a sudden spike in volatility. This is something I'm thinking about trying in 2025, but I'm a little antsy about it. I think that's the part of my brain that I haven't wreaked havoc on with cheap vodka in my 20s, trying to keep my reptilian brain from going down the path of darkness with options trading. If your goal is to take a short position against the market, you could do the standard buy puts on SPY approach, or you can buy calls on UVXY like we talked about. If you do the latter, just at least try to do it when the IV rank is less than 25%, and understand that even holding the quote-unquote shares of UVXY puts you at the mercy of some pretty aggressive time decay. UVXY is a financial instrument that's meant for a quick in and out adventure. It's not something you want to be holding long term. It's definitely not a beginner-friendly instrument, so if you're unfamiliar with volatility derivatives, set aside some time to familiarize yourself with them a little bit. If you're smart, you'll enjoy learning about it and then avoid it. But I'm not here to judge. There is, after all, something to be said about learning by doing. And by learning by doing, I mean losing all your money. Another way to play volatility on an individual stock basis is by buying iron condors. I might enter a couple of these with 2 to 3 weeks until expiration on Square or maybe even Tesla. The benefit of an iron condor is that it's a non-directional defined risk strategy that essentially allows you to make money if you expect the stock to be volatile in either direction. I think we can count on Elon Musk saying something stupid and the subsequent media circus that triggers some sort of erratic price move in the stock price. Tesla does indeed move in mysterious ways. Whether you're going long UVXY or buying SPY puts or trying to play volatility with iron condors, it can be helpful to think of the first two strategies as insurance policies that pay out if the market goes south. I think the insurance analogy is slightly less applicable to the condor. Anyway, you don't buy auto insurance hoping for it to pay out. It's quite the opposite. You're hoping you'll never need it, which essentially means that you're still generally bullish on the market overall. You're just trying to take a small position in your portfolio that profits in the event of a sudden spike in volatility. Let's pretend you bought calls on UVXY because you've defined a long-term thesis, strategy, and short-term tactics that you're going to monitor and defend on a daily basis. I'm just kidding. We know none of that's going to happen. You just want to YOLO into some calls on UVXY because you think it'll print money overnight. Your best case scenario as a committed UVXY long is if there were to be a catastrophic market event within a week or two after you buy it, like if one of the handful of leaders of a nuclear-armed country were to have a bad day and finally decide to push their big red button, for example, or if we get COVID-20 and the economy collapses again, or if an asteroid slams into New York City, or if Jerome Powell decides not to lower interest rates by 25 basis points at the next FOMC meeting. You can dream up whatever hellish nightmare scenario you want here, but any of these events would obviously be enough to bring the market to its knees. But back to our original topic, hedging against a market downturn, or something. Options and leveraged volatility ETFs, like UVXY, can essentially be thought of as insurance contracts. And insurance is a funny thing. For example, think of what you're doing when you sign up for health insurance. You're literally betting against yourself being healthy. You're actively betting that you will break a leg, or get so sick that you need medical attention whose cost will be in excess of $10,000 or so, after factoring in your company's crappy high-deductible healthcare plan. So you grudgingly sign a contract with your friendly local health insurance concern that pays out when you injure yourself. Unless your insurance company is United, in which case you're probably not getting squat. They'll instead send an email to your doctor mid-operation being like, "Nah, we're not paying for that, fuck you. Just put some ice on it and get him the hell out of here." You might be starting to see a theme emerging in my videos. Pretty much every aspect of your financial life is built around, or is at least comparable to gambling. Your auto insurance is the same. You know you're probably going to stay awake behind the wheel, but if you were to get distracted and suddenly swerve into a telephone pole, you're going to be glad you had insurance, because insurance pays out when bad or stupid things happen to you. But mostly, it's just you giving lots of money to the insurance company and getting nothing in return. Which is why, in an options trading context, I'm usually a net seller of premium. Continuing our insurance analogy, insurers employ armies of math nerds whose job it is to determine the profit-maximizing premium with which to extort you, effectively maximizing shareholder value. The healthcare system writ large won't price premiums so low that everyone can afford healthcare. Economically, there is an optimal price which maximizes insurance companies' revenues at the expense of full coverage. Full coverage wouldn't be profitable since you're covering people who need healthcare, which kind of defeats the purpose of being in the health insurance racket. But pricing your premiums at $20,000 per month will pretty much guarantee that you have no customers. There's an optimal price where revenue is maximized. Once the insurers have revenue maxed, their attention then turns to controlling costs by refusing to pay for your bitch-ass inhaler or fixing your broken leg after you swerved into that telephone pole. They make up all kinds of bogus reasons, like he was drunk, or he was distracted on his phone because he was trying to manage 0 DTE straddles while driving through a school zone. You know, screwing the little guy. Does anyone remember what we were talking about? Oh yeah, options. My point is, insurance is a great racket, and in many ways, it's analogous to options contracts, which again is partly why I'm usually a net seller of premium. But when it comes to our desire to hedge against a potential market downturn, it might be worthwhile to at least consider starting to pay into the system, at least a little bit. If buying UVXY calls or SPY puts seems expensive, you could partially offset some of that cost by shorting your short position. And now we get to the part of the program where things get unwieldy. Shorting your short position, whether it's calls on UVXY or puts on SPY, using a defined risk strategy like dollar-wide call debit spreads or even put credit spreads, for example, might be a way for you to reduce the cost of your longer-dated bear plays. That way, if there's a sudden drop in the market or a spike in volatility, your bear or volatility play will print money, while your defined risk bull spread would only lose that dollar-wide collateral that you had to put up. basically $100. Again, you know how I feel about trying to churn $12 a week using zany multi-leg option strategies when your overall purpose for entering a position is directional. But because our reason for doing this is less about having a strong bearish directional bias and more about hedging against a potential downturn, I'm less against doing this sort of thing. I'm not endorsing it. I'm just saying that I understand it, and that there might be a place for that sort of thing. If you do go long UVXY, what you could instead do is maybe sell dollar-wide bull spreads on SPY, which are a good stand-in for shorting volatility at the end of the day. This might be tempting because UVXY basically hemorrhages value over the long term, so shorting it using a defined risk strategy could help you reduce the total cost basis of your bearish position. Let's say your call spreads earn you about $10 a pop. If there's a market crash, the underlying shares of UVXY, which is super volatile as we discussed, are likely to double over the course of a few days, possibly even more. If you had been selling dollar-wide bull call spreads on SPY, the only amount you've got at risk is the collateral for your spread, which will be a drop in the bucket when your long position in UVXY starts printing cash. There's a reason I'm telling you all this. It's so you don't do it. There's probably an easier way. Why even bother shorting your short position and stepping on your own foot, and then overcomplicating your life further by managing your short volatility positions, which isn't even technically short volatility, but short the SPY, and then have the added stress of picking the right strike prices and making sure you collect enough premium from these weekly hedgers whose sole purpose is to reduce the overall cost of the insurance policy you paid by entering a SPY put or buying UVXY calls. Oof. There's an easier way. If you've got a bigger portfolio and think the market might have a volatility spike in the next 2 or 3 months, and you're willing to buy calls on UVXY for, say, a total of $2,000, then just do that. Or if you're a smaller portfolio, just buy one further out of the money call and roll it occasionally. If there's a volatility spike, UVXY will probably blow through your out of the money call anyway because of how volatile it is. Unlike meme stocks, if your strategy is to hedge against volatility, then buying a slightly out of the money call on UVXY could potentially print money, because when and if the market suddenly does sink, your underlying should spike in value over a very short time period. If you want to try to churn out $40 in premium per month to hedge against your market hedge, and you estimate a $480 per year option premium being collected from doing that, then you could save yourself the headache and just buy the net amount of UVXY you would expect to earn after churning all that premium, which is $1,520. If you budget a monthly market crash insurance cost for the quarter of, say, $127 per month, you could use that budget to just DCA $127 per month into UVXY calls or SPY puts, for example. This means that you are comfortable with your portfolio basically paying $127 monthly insurance premium against the market each month. This quote-unquote policy will pay out when your portfolio crashes into a telephone pole because the market crashed 15% in a single day because Jerome Powell was spotted stumbling around drunk with a 40 in his hand. So do yourself a favor and make your life easy. If you try to short your short using bull spreads or any number of other things, you could end up not only paying the $2,000 in premium you were going to pay for the UVXY calls or the SPY puts, but also potentially losing even more money because, surprise, surprise, there's a good chance your bull spreads go tits up as well. How confident are you that you're going to be able to pull it out of the bag consistently with these 7 or 14-day bull spreads? If you're like me, you're starting to get a bit lost in the sauce, and your brain is probably too scattered to focus on what you should really be doing, which is finding less unhinged trades, probably. But if you've watched the video until now, and you haven't heard of UVXY or any of the other crazy stuff we talked about, then congratulations. Now you know. Pandora's box of losses is wide open, so proceed with caution. But in all seriousness, obviously be careful if you are going to try any of this. Really take the time to study the numbers, look at expected moves, and if you're going to try to buy calls on a leveraged security like UVXY, do your best to buy it when its IV rank is on the lower side. If you don't know what you're doing, advanced strategies often lead to advanced losses. Going long on volatility by buying calls on UVXY or puts on SPY are both very aggressive bets that something is bound to go wrong. Betting on a spike in volatility is like having an insurance policy that pays off when the market goes kersplat. You hope you don't need it, but when you do, you're going to feel very smart and have some killer gains to share next time you're trying to impress people at a social event. No, but seriously though, don't be this guy. Nobody likes this guy. So if you are someone who's nervous about the big one and want to short the market, the move might be to play UVXY or more traditionally buy SPY puts. A quick tip. If you actually want to do this, don't go all in on January 1st. It's better to spread out your entry points to achieve diversification of strike prices across time. You probably won't time a dip perfectly on try number 1, meaning your odds of actually doing it increase the more attempts you make. If you've got a firm budget in mind of how much of your portfolio you want to use to hedge against the market slump, you can buy SPY puts and roll them on a weekly or monthly basis, biding your time until the thing you want to happen, but also don't want to happen, happens. There are many ways to short the market. The method you choose depends on your own personal risk tolerance, budget, and where you sit on the doomer spectrum. If you listen to Harry Dent or Robert Kiyosaki or this YouTube page, which is particularly egregious with the doomer takes, you're going to want to get an advance on your credit card, HELOC your house, and dump every cent you have into out-of-the-money SPY puts and gold and military rations. I hope the construction of your doomsday bunker is proceeding nicely, by the way. My best case scenario, if the market tanks, is that by only being in about 30% of my capital, I can shield the majority of my cash from getting vaporized in the event we were to suddenly enter bear market territory. Meanwhile, my 1.5 times leverage long position on UVXY should print cash, unless I forget to check my account for the 2 or 3 days I have before volatility gets crushed again. But you shouldn't be playing around with volatility unless you plan on being fairly attentive for the duration that you're holding it. What else can we do to fudge around with volatility and generally toy with forces we don't understand? We could open some iron condors on Tesla. Tesla's volatility is out of control, so betting on wild price swings might work out in our favor. The operative word here is might. Again, iron condors are good as a volatility play because you essentially have 2 scenarios that pay out, which aren't necessarily directional, but rather which depend on volatility. The other thing that's kind of cool about iron condors is that it allows you to make money in either eventuality, essentially using the same collateral. For example, if you were to open a dollar-wide call debit spread and a dollar-wide put debit spread, your collateral would be $200. But if you combine these into an iron condor, the collateral is only $100. If you believe in Elon's power to be a catalyst of volatility, then boy do I have a strategy to sell you. But this is all assuming you can get an order filled. I've been trying to do a $2.50 wide condor for like 3 weeks till expiration, but Mr. Market appears to be firm on that, costing $2.48. The bid-ask spread is totally fucked. You know, without even checking, that Tesla's IV rank is probably on the high end right now anyway, so good luck if you want to try this without paying out the ass for premium. Elon Musk's crackhead tendencies are by now fully priced into the market. It's called market efficiency. We've talked about a few ways to play market dips, and my personal favorite is going to be long condors, just not on Tesla. I'm going to try some of these strategies in Q1, and we'll see how it turns out. I'll either make money, get wrecked, or make the same returns I've been making with like 5 times the amount of effort, which again is kind of contrary to my investing style, but hey, everyone needs a hobby. If you're going to try any of these hedging strategies, position size accordingly. All this crazy stuff should be a sliver of your portfolio and by no means the main event. Remember, there are 2 ways to trade options, like a risk manager or like a gambler. I think you know which one you need to be. Sometimes I do wonder if I'm doing too much. Maybe I should call it a day and put all my money into a 60-20-20 portfolio and find a new hobby. Yeah, we're not going to be doing that. See you in the next one.